So let's go through an example and make sure you follow along in your workbook. So the stock that we're going to do is Merck. MRK is the ticker. The trade date is December 11th, 2017. The stock at the time is $56.34, and I am long Merck at $50. I'm going to write that right there. So I've got a nice gain in the stock already, and I want to put on a protective collar because I'm worried about if Merck falls. So how am I going to do this? I'm going to sell one of the Merck March 57.5 calls, and I'm going to collect $1.45 for this, and I'm going to simultaneously buy one of the Merck March 52.5 puts, and I'm going to spend 97 cents. So it's a net credit of 48 cents. So I'm going to receive that in my account for this protective collar. Now let's look at this trusty P&L graph that starts right here. Now as Merck is kind of just going through and not really doing too much, you're not noticing much on the P&L graph of this structure. Then you see a big gap up in Merck, and it looks like we start to lose money based on this structure. But remember, I told you I'm long 100 shares of stock. So the P&L that we're losing on this structure, we're actually making on the long stock. So don't worry about that. Then you start seeing the P&L of the structure start to lift. That's as Merck comes back in line. Where did Merck eventually settle? Right around $54.63. And what do you see the P&L of our structure? We're actually making a little bit of money, and that's because Merck settled between the strikes, 57.5 and 52.5. So there's no right to sell stock or exercise my put, and there's also no obligation to sell stock because of my call that I'm short, because Merck at expiration is below 57.5. So let's go ahead and calculate our max loss and our max gain. Remember, the stock is Merck. It's trading at $56.34. The date is December 11th, 2017, and I'm long 100 shares at $50. So I'm worried about the stock falling, so I'm going to put on this protective collar out through March. So let's go ahead and calculate our max loss. So we're going to take the put strike of 52.5. I'm going to then subtract my stock entry price of 50, and then I'm going to add 48 cents because that's the net premium I collected. That's going to equal $2.98. How many times did I do this collar? 1. Also got to multiply the 100 multiplier because it's stock. And the max that I can lose is $298. Remember, your max loss is going to be positive because you're trying to protect gains. So now let's look at the max gain. The way you calculate max gain is you're going to take the call strike, 57.5. You're then going to subtract your entry price of the stock of 50. We're going to add the net credit of 48 cents. That equals $7.98. We're doing this one time, one contract. Now you're going to multiply times 100. It's a 100 multiplier for stocks. Your max gain is $798. So let's go ahead and calculate our break even and our net result. So to calculate break even, you're going to need your stock entry price, that's 50, and then you're going to subtract the net credit. So that equals $49.52. So as long as at expiration Merck is above $49.52, you're going to break even on this trade. Merck price at expiration was $55.67. So that's between the strikes of 52.5 and 57.5. So the net result is going to be the premium that I collected. So let's go ahead and calculate our net result. And remember, Merck expired between the strikes. So that means there's not going to be an obligation to sell stock and I'm not going to exercise my right to sell stock either. So remember, I sold that call and collected 145, which I'm going to keep all of because Merck was below 57.5. And I also am going to lose all of that put premium that I paid, or 97 cents, because it expired worthless, 52.5 strike. The net result here is I keep the 48 cents premium. How many times did I do this protective collar? 1. And then the 100 multiplier for stocks. The net result is $48, which is the premium that I collected at the beginning. So as you can see, a protective collar can really come in handy if you've got big gains in a stock that you're long. So remember, adapt a protective collar to your hypothesis. You're worried about losing some of those gains. You think the stock is going to fall. And also, assess the outcome of applying this combination to your strategy. So know your break-even points, know your max gains, and know your max losses. Why don't you try another example in your workbook?